Yeah, it's a very different type of crisis. I mean, these crises keep recurring. They're always a little bit different. They have different magnitudes. Bank failures are pretty actually common in American history, unfortunately. And so I would just make sure, people should make sure that their bank is safe, that they're, making use of FDIC insurance limits. Don't assume that all deposits are covered just yet. Take prudence. Um, and going forward, there's even risks later this year because we still have the debt ceiling impasse. And if the Treasury tries to after that's resolved, if they try to refill their cash account, that could be another source of liquidity coming out of the market. And so I think basically the Federal Reserve is going to have really big decisions later this year. And it's certainly not a position I'd ever want to be in.
In this, our guest is Lyn Alden, who's a prominent investment strategist and researcher who specializes in analyzing macroeconomics, investing, and financial history. As the U.S. banking crisis persists, Alden reports that the Federal Reserve has injected a significant amount of funds into the economy to prevent a potential catastrophe. While there is a 29% probability that interest rates will be between 3.75% and 4% by January 2024, the current rate remains at approximately 4.58%. The cryptocurrency market has experienced a significant upswing following the Federal Reserve's recent injection of liquidity, leading many to speculate that quantitative easing may be making a resurgence. Lyn Alden believes that the strength of the US dollar has a considerable impact on the value of Bitcoin. According to Alden, the monetary and fiscal policies of the US government can directly influence the value of Bitcoin. In the event that the government enacts policies that heighten inflation or depreciate the US dollar, Bitcoin could become an increasingly desirable alternative investment. Before proceeding further in this video, make sure to click on the subscribe button below to stay updated with our latest content.
Bitcoin and gold, and some stocks that are doing pretty well. And it's things that were rate sensitive. So, for example, someone believed that Powell was going to keep hiking, that he was going to get the positive real rates and then hold them there for a long period of time, then the dollar's super stable. And, it basically makes it attractive and it makes most other assets unattractive, right? If you can get a positive real yield on, your treasuries and your things like that, it makes other assets less urgent. On the other hand, if they rapidly cut interest rates and they're not able to tighten even in the face of persistent inflation, then that makes those scarce assets more attractive. Things like Bitcoin, things like gold. And so if that breaks perceptions of overall Fed tightness, that is beneficial to those alternative scarce monies. Now, I'd be careful about chasing things in the near term. I mean, short-term moves can always reverse themselves over any multi-week or multi-month period. But I do think that Bitcoin is showing a lot of resilience in the recent months, and especially with this particular event, and that this is a good advertisement for Bitcoin. Um, and moreover, just that rates backdrop and the inability of Fed to tighten as much as they would have otherwise wanted to is beneficial to Bitcoin. And that's kind of always been part of the thesis. I mean, if someone believes that the dollar is going to get back on track and it's going to stop losing value, then, people can hold dollars. Whereas if, Bitcoin's kind of the thesis that that's not going to happen, the dollar is going to keep devaluing in purchasing power, even when taking into account interest rates. And therefore, that Bitcoin is a better long-term money to hold, in addition to being censorship resistant and global and all the other properties that it has.
As Alden points out, banks could potentially avoid significant losses by holding onto their securities until maturity and receiving their principal back. However, not all banks have the financial capacity to do so. According to Alden, in the event of a bank run where depositors withdraw more cash than the bank has on hand, the bank may be forced to sell its heavily discounted bonds, resulting in a permanent loss. This is precisely what occurred with SVB. To meet redemption demands, the bank had to sell its $21 billion bond portfolio at a loss of $1.8 billion. It is crucial for banks to assess their financial stability and liquidity to prevent such losses. The biggest problem with fractional reserve banking is the threat of a bank run because the banks only hold a fraction of the deposits. If a large number of depositors simultaneously demand their deposits back, the bank may not have enough cash on hand to meet those demands. In her recent tweet, Alden said that since it's a duration problem rather than a credit problem, the banking system can potentially break itself back into solvency. Meanwhile, the big banks eat up the small banks, good, stable, well-designed system we have here.
To zoom out, there was like that 40% increase in the broad money supply in a very short period of time, and most of that broad money supply is bank deposits. So banks, even though those are customer funds, those are liabilities for the bank, and they're holding them for the customer. So they basically had an influx of deposits, and they had to invest them in something. And a lot of them put them into relatively safe securities, things like treasuries or mortgage-backed securities, which are among the safest assets that a bank can hold. The problem is that those have duration, right? So they might be like 5-year, 10-year, or longer duration assets. And you had this record increase in the broad money supply, super low rates, and then it led to inflation, among other factors. And so the Federal Reserve freaked out and completely, 180-degree reversed their monetary policy. So they started sucking money out of the system, and they started hiking rates at the fastest rate since the 1970s. And so all these banks that bought these longer duration safe assets suddenly found their positions underwater. Now, there's two big risk factors that go into why this particular bank had such a big problem. One was that their deposits were not very high quality because they were concentrated in one industry, tech startups. And because they're mostly business bank accounts, most of them were well above the FDIC limit. Um, and so they had, they're at risk of loss if there should be a bank failure. And so they're basically deposits that are very, very quick to want to move at any sign of a problem, which is not the case when you have a very diversified and smaller, kind of a large number of small accounts. So one is their deposit base was at risk, and the number two is they did not manage their duration well. A bank like JP Morgan, for example, got more into shorter duration types of assets. So they had less losses when interest rates increased so much. Whereas this particular bank, basically made a pretty big bet on long duration assets, which is not like the riskiest thing you could have done, but it is risky because those are relatively safe assets, but they have pricing risk. And so that bank had a particularly large amount of losses relative to its capital and had a very flighty deposit base. And a number of other banks that either were taken down or were kind of on the verge of going down had somewhat similar risk profiles, both in terms of the deposit side and the unrealized losses side.
In order to alleviate concerns about potential deposit losses, the FDIC offers insurance coverage for up to $250,000. Alden highlighted that it's important to note that the FDIC only holds about 1% of the total value of bank deposits in their insurance fund at any given time. It's worth noting that the current banking landscape is different from the situation in 2008. Banks today tend to hold a greater percentage of their assets in cash and treasury or agency securities, which are generally considered low risk if held until maturity. While taking in concern the current bank situation, Lyn Alden tweeted that if one bank is too safe, it can suck deposits out of the whole system towards that bank. Most of the current two-tier banking system would make sense if that full reserve bank exists. So regulators ironically want banks to be safe, but for none to be too safe. Banks are facing unrealized losses as a result of purchasing numerous securities during the low interest rate period that are currently trading at significant discounts and may have to be sold at a loss.
Challenges is that, of like the 17 trillion plus deposits that are out there, the FDIC only has, less than 1% of those deposits backed up by insurance. Even the ratio that is fully covered by insurance, they only have something like 1.3% covered. Now, to their credit, I mean, since 1933, they've never not paid on a insured deposit before. But basically, it's one of those things they don't want huge, vast bank runs happening. And a lot of this is a confidence game. That's kind of the whole game of fractional reserve banking, is that these institutions are inherently unstable. I've described it as basically like we're all just casually storing our money in leveraged bond funds. And so obviously that's, if you phrase like that, would you say, is that a low risk investment? People would say, no, of course not. But that's what we all just casually use for our, savings. You would just put grandma in a highly leveraged bond fund, and that's where she holds her money. We kind of normalize that. And so they wanted to backstop confidence in the system. And they've also added this liquidity facility. It ironically generally benefits the larger banks because you can only use that facility if you have a lot of high quality liquid assets. And whereas if you look at the long tail of smaller banks, they're generally more loan driven. They hold illiquid loans that they made and that they're not really easily resellable. And so they can't use that particular facility. And so I think we're in an environment where the large banks are pretty well protected, whereas small banks probably still face ongoing challenges.
The possibility of more bank failures and the potential for contagion to spread to Europe has led to concerns about the global financial crisis. In this context, cryptocurrencies are being viewed as a safe haven from the turmoil, similar to what happened during the 2008 crisis. That's all about today analysis. It is important to reflect on the implications of the global financial crisis and its impact on the economy. Do you agree with Lyn Alden's perspective on this matter? Share your thoughts in the comments section below. If you found this information helpful, please give this video a thumbs up and subscribe to our channel. We will continue to bring you more updates in the future.